Welcome to this Kentucky Homebuyer Guide video on mortgage approval Q&A. We'll provide simple answers for getting pre-approved and choosing the right loan path, covering credit, approval processes, and typical costs. Mortgage approval starts with three key components: your credit score and history, your gross monthly income and documentation, and the funds you have for a down payment, closing costs, and reserves. A strong file shows the lender you are ready to buy. What credit score do I need? Many Kentucky no-money down options commonly look for a middle score range of 620 to 640. Remember, actual approval depends on your full loan file and specific lender requirements. Here are some common credit score expectations for Kentucky first-time buyer loan options. The USDA Rural Housing and KHC assistance generally look for 620 to 640. The VA loan is around 620, and some lenders allow as low as 580 for FHA with 3.5% down. Lower scores may be harder to get approved. Guidelines are not the whole story, as lenders may add overlays, setting stricter requirements to manage risk. Always ask your loan officer, what middle score do you actually require for my loan program? If your score is in the high 500s or low 600s, a rapid rescore might help. This involves reviewing your credit report, taking targeted action to correct errors, and rechecking the score, which may show improvement in about 30 days. Does it cost anything to get pre-approved? For most lenders, the answer is $0, just to get pre-approved. However, a credit report fee may apply, typically around $50 or less for one borrower for a tri-merge report. How long does approval take? If your income and asset documents are complete, a lender may be able to issue a pre-approval decision in about 24 hours. Having income and asset proof, along with a complete file, helps speed up the process. Documents speed up approval. A complete file helps the lender move faster. Be ready with income proof, asset proof, and a complete application from the start. The cleaner the file, the faster the answer. Who reviews my mortgage file first? Most lenders use an automated underwriting system like Desktop Underwriter, or DU, for conventional loans, or the Guaranteed Underwriting System, or GUS, for USDA Rural Housing. Automated findings can speed the review, but the lender still verifies your documents. If the automated system cannot issue a clean approval, a manual review may be needed, which takes longer. Common triggers include credit issues, high debt ratios, or limited funds. Manual underwriting doesn't mean no, but it does mean more documents and time. Are there Kentucky assistance programs? Yes, Kentucky buyers may have access to down payment help or even zero-down loan options. Availability is contingent on your credit, income, property location, loan type, and program rules. Ask your loan officer about various programs like KHC assistance, USDA Rural Housing, VA loans, Fannie Mae options, HUD $100 down, and city grants. Program availability is not automatic, so ask early. When can I lock my rate? Usually, you lock with the lender after you choose a home and go under contract. The process is: get pre-approved, select a property, then lock with the lender. A rate lock starts once the file has a real property address. Rate locks help protect your monthly payment by holding your rate for a set window. Be aware that 90-day locks may be available, extensions may cost money, and longer locks may cost more. Ask your loan officer, how long is my lock, and what happens if closing is delayed? Can your mortgage rate change? Yes, rates can change daily until you lock with the lender. Think of it like gas prices. The quote you receive is helpful, but the lock is what protects the rate for your closing timeline. Always ask, what is today's rate? And when can I lock it? How much money do you need? The answer depends on your loan program and contract. Key factors include the loan program's down payment rules, the purchase contract terms, and any credits or assistance you receive, all of which affect your final cash to close. Even with a low down payment or zero down loan, you may still pay certain costs before closing. Common upfront costs include the good faith deposit, the appraisal, a home inspection, and sometimes a termite report. Budget for these early. Closing costs may be negotiated. Before writing an offer, ask how costs could be paid or reduced. Options include seller-paid costs, lender credits, and a detailed fee breakdown to understand all charges. Ask your loan officer about options to lower your cash to close. How long is your pre-approval good for? Most lenders honor a pre-approval for about 120 days, provided your credit, income, assets, and debts remain consistent. A pre-approval is a powerful tool, but it is not permanent. After 120 days, your file may need an update or a refresh before you keep shopping. This confirms your credit report, recent pay stubs, and bank statements still support the loan. Keep documents current so your approval can be refreshed quickly. How much income do you need? Approval is usually based on debt-to-income ratios, not income alone. Lenders compare your income versus your debts, asking if you can handle the new payment comfortably. Two ratios determine your maximum payment. The front-end ratio is your house payment, divided by gross monthly income. The back-end ratio adds all monthly debts to your house payment, then divides by gross income. Debts like car loans and credit cards count, but utilities usually do not. In a qualifying example, when two debt-to-income calculations result in different maximum house payments, the lender must use the lower qualifying number. This ensures the borrower can comfortably afford the total monthly obligations. Ready to get pre-approved? Start by talking with a Kentucky mortgage professional. Prepare your income documents, bank statements, credit history, and program questions to help move the process quickly. Final approval depends on a full review and program requirements.